Hello, everyone. I'm Angelo Robles. I'm the host of the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. I really enjoy hosting these interviews. It's a great chance for me to learn so much from all the amazing guests that I have on, including today. To give a little bit of context to my conversations, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. Today's session, we titled, and it's going to be much more than that, but Meet the Father of the Jobs Act. It features David Weild IV, founder of Weild & Company and former vice chairman of NASDAQ. I'll give you a little bit more context about David. As noted, he's the founder, chairman, and CEO of Weild & Company, the in-cloud network investment bank. He is widely known as the former vice chairman of NASDAQ, whose work really was applicable in Congress and the SEC to take action to improve capital formation. We have a lot to discuss on that. This led the chairman of the House Financial Services Committee to call him, and he was labeled, as I noted, the father of the Jobs Act. Mr. Weild testifies in Congress, the SEC, and at the economic events, including the Organization of Economic Cooperation and Development and the G20. He was named one of the 20 visionaries in The World's Most Influential People in Market Structure, a book by Patrick Young. David, it's a pleasure to welcome you on the show.
Thanks, Angelo. It's great to be here.
Well, we have a mutual acquaintance, and that would be the one and only Gino Isaac, who had a chance to introduce us. I enjoyed our one or two conversations in the last month. I learned so much, and it's been truly a tremendous pleasure. We have a fair amount to discuss because you got such a rich and engaging background. Why don't we begin with, tell us a little bit about the work that you've done, and please do not be modest. It's so incredible that really the discussions that you have in Washington and the SEC, and like I quoted, applicably being named the father of the Jobs Act, which we'll also dive into a little bit as well.
Well, I would say that I'm a patriot first and foremost, and I put my red, white, and blue epaulets on when I go down to DC, and I don't think about what's in it for me when I testify. I'm concerned about the rate of innovation, the rate of entrepreneurship, job formation, the kinds of things that are going to contribute to solving the great challenges of the future, so that we leave a better country for the next generation. And so, you know, what struck me when I was vice chairman of NASDAQ, and I was presiding over that period of time over the listings businesses globally, when they changed market structure and collapsed trading spreads and commissions, and we saw the bottom drop out of the small cap IPO market, and so we knew what had happened, but seemed that the regulators didn't understand the cause and effect because it was during the middle of the dot-com bubble. So, you know, years later, I started pulling together data to basically be able to demonstrate that and get other people to see it. And lo and behold, we discovered that 80% of small IPOs basically disappeared in a very short time span during the dot-com bubble from 97 to 98, and it never recovered. And it's just to give you a sense of the dimension of it. On a GDP weighted basis, it would be as if we're doing about, well, today we're doing about 120 to 140 IPOs a year. And if we hadn't changed market structure, we'd probably be doing 10 times that amount, okay? So that the ability to birth entire new industries, which was dependent on what was the greatest IPO machine in the world, and it caused the United States markets to be the envy of markets across the globe, was obliterated by the unintended consequences of this sort of rush to low-cost electronic trading. And so we've been talking about that, and we've been getting, as I like to say, changes to in legislation to enable crowdfunding and other things to start to improve access to capital for entrepreneurs and get more and more companies to go public. And look, somebody just chatted, that that Palantir still hasn't gone public. Well, the gestation periods went from, this is the sort of the punchline, went from an average of about 4 years before a company did an IPO to 10 years. And this has broad implications. We're seeing concentrations of capital geographically. We've created a bigger flyover state problem in the United States. The numbers of startups have declined dramatically. So we want to fix all that. We want to get the United States back to where I believe we belong, which is the greatest entrepreneurial nation on earth.
Wow. So you give me a lot to chew on there. My audience knows that probably entrepreneurship and venture capital and investing from that perspective is probably the most common investment subject that we cover. And I've been blessed and lucky at my physical events and digital to have had on some of the biggest names in the community. And America, to me, has always been the pillar when it comes to entrepreneurship. We're a country that actually forgives those that try and fail as long as they're resilient and get back and try again. And simply the opportunity from contract law to bankruptcy law to the atmosphere of that kind of spirit is really integral to America. I would say from the perspective of angel and venture investing, we're still dominant. You certainly have China that's up and coming, other countries in Southeast Asia. Israel certainly is wonderful, but obviously a very small country. But from the way you say it, and India is definitely going to be a major force in that part of the community as well. What are the things that we could do to maintain the edge in America to inspire people to start businesses, to be entrepreneurs? And I know my audience has heard me say this so much. People don't realize that people found businesses, they employ people, they pay taxes, they support communities. You know it, I know it, but you're going to be more eloquent than me in terms of why that's so important to the fabric of this country, really to any country, and to sustain moving forward.
Well, we have a massive amount of capital in the United States equities markets. I mean, call it in round numbers, $40 trillion, and probably 32 or so of that trillion is invested in just the S&P 500. And so, to think about the problem in terms of igniting a revolution in economic growth, and we just need to figure out how to make it more interesting to move some of that capital to earlier stages. And part of that, earlier stage companies, right? I mean, every Fortune 500 company once was a startup, and you have to plant seeds if you're going to grow back a forest. And so just getting the rate of entrepreneurship to increase. I wanted to follow up with you, Angela. I agreed with everything you said about culturally, we're a great nation for entrepreneurship for exactly the reason you said, which is to forgive failure and to get back up off your duff and to go at it after you failed once and do it again. Practice makes perfect. And so that's really one of our, the great secrets of our success. It's also the kind of the multiculturalism of the United States. We bring together people with different perspectives. And so as a consequence, those novel combinations allow us to see things, I think, many times that others don't. But we need the toolkit and the incentives to get the capital into the hands of people that want to start businesses. And so, crowdfunding, one of the great things about crowdfunding is it gives you a toolkit to get businesses started. One of the bad things about it is still a lot of the capital that comes in is from friends and family. And so you could be, Black Einstein in the middle of the hood in Baltimore, and your friends and family don't have money. And it's going to be very hard to get a business, started. And so, the use of incentives, tax incentives, and other things to give somebody money, somebody with money, an incentive to invest in a business without money, those kinds of things could ultimately be, revolutionary. Those are things that I'd love to go back to Washington with, because I do feel that not a believer in socialism, but I am a believer in enabling opportunity and to giving people a shot in the arm. And I think there are many ways that we can do that. But circling back is just to show you how troubled we are at some level. I mean, one of the very compelling graphs that we put together that changed the conversation in Washington was we looked at indexing to when we changed market structure in 97 and 98, which was when we went to all electronic market structures through a couple of rules, the order handling rules and Reg ATS, alternative trading systems. And the United States had and this is taking all the funds, all the junk out of the number and just looking at operating companies. We had 9,000 publicly listed operating companies. You know, those are job creators. Those are the businesses that employ people. And it dropped like a stone and bottomed out at around 5,000 when we changed market structure. And in the meantime, and we ran a graph against something like 12 other nations. We got this data from the World Federation of Exchanges and put it up. China was growing like a weed. On an index basis, they were just crushing everybody else. And so, it's the trend is your friend. And if your trend is down, you don't look very good. Well, subsequent to the Jobs Act, where we created Regulation A+ and crowdfunding and some other things, we've testing the waters, which SEC Chairman Jay Clayton has now made available to all public companies. In part, I believe, I don't want to put words in the chairman's mouth, but when WeWorks went to the market to try and do an IPO at a $40 billion market cap, which failed, and then got recapped in the private markets at $8 billion, I think that we woke up and we sort of said, holy mackerel, how can big Wall Street firms miss the valuation by so much? And the simple answer is electronic markets have become so efficient that they've stopped the sell side from having conversations with the buy side about fundamentals. They don't value, the buy side doesn't value the sell side's research any longer. And so as a consequence, the kind of the knowledge of what fundamental investors are really interested only occurs around these new issues when you're starting to do testing the waters. And so that's why I think the chairman may have made the testing the waters provision, which comes from the Jobs Act, available to all public companies, not just companies that were covered as emerging growth companies under the Jobs Act.
I think it's important that we probably do take a little bit of a step back in time and talk about the Jobs Act, or at least highlight the key areas that we're focused on today, spurring the opportunity for entrepreneurship and small business. So most of it is going to revolve around crowdfunding. You and I are using that term, making the assumption, which probably we shouldn't do, that people know exactly what that is. If you could talk a little bit broadly, yet also narrowly about the Jobs Act, and we'll focus in on crowdfunding.
Right. Well, so the Jobs Act was an omnibus bill. It was a roll-up, if you will, of 6 different bills, and it did a range of things. And the reason why I get called the father of the Jobs Act is because the papers we wrote basically changed the conversation. It frankly, I think, caused a lot of fear on the part of congressmen that we kind of lost our edge and our entrepreneurial mojo, for want of a better description. And so they went back and they came up with their own solutions. Reg CF, which is the traditional crowdfunding title of the bill, actually allows you, an entrepreneur, to raise up to $1 million from individual investors, but none of them can put more than $5,000, and that can be public investors. And that was revolutionary because, up until that point, early stage companies could only access capital from accredited investors through the private placement process. Now, there's been some talk about, I think it was moved up to 2 million. I'd have to check my facts. I don't really work with that. And I know that the chairman of the SEC had wanted to move it up to 5 million. I don't know where that stands, but that was the original limit till people got concerned with selling early stage growth companies to public investors. The problem is, my view is, look, I mean, we can sell them all sorts of junk, we want to, and, without any value. You can do a crowdfunding site without any of these restrictions and sell somebody, a pre-release of a product that never gets produced and people can lose their money. There's no reason why we shouldn't allow people, as long as they limit the amount of investment they make, to invest in securities. The cumulative upside so far outweighs the downside to the economy and to people in terms of growth that I think that there's an overriding public interest in doing it, but that's a point of philosophy. Probably more important, and this one actually came directly from me, was the repeal of the prohibition against general solicitation in private placements. Historically, you could not go out and generally advertise or market private placements. And what we said was a little bit like acting like the little boy in the Emperor's New Clothes. We said, why does it matter who we market to. All that should matter with a private placement is who actually writes the check. Okay, so we said, let people go out and market, okay, but then make sure that those that actually invest are all accredited. And that gave birth to 506C, which allows you under a separate methodology. You have to get a third party to endorse or to actually verify or attest to the fact that you are accredited. And now you can go and do a private placement, which is generally marketed. And that's actually turned out to be a great arrow in the quiver of many entrepreneurs. And you know, there's always a lag, right? The Jobs Act was signed into law on April 5th of 2012. I was in the Rose Garden with President Obama when he signed it. Steve Case, who you probably all recognize, and Steve was the chairman and CEO of AOL, and is now runs his own venture capital fund. His brother Dan Case, coincidentally, was an old friend of mine. He passed away tragically in the late 2000s, but he was the president of Hambrecht-Quist, Harvard MBA, terrific human being, by the way, and miss him. We then had Regulation A+, which is sort of IPO light. They're still, working on tweaking and getting that one to work, but we're starting to see more interest in it. And that allows you to raise capital from the public with less stringent sort of disclosure requirements, up to $50 million. Some talk about taking that up to $75 million. You now also, from the Jobs Act, can remain private with up to 2,000 shareholders. The prior limitation was 500 shareholders. So basically, the act is giving people a broader range of tools to access public markets with more efficaciously and with less associated cost.
I mean, that's incredibly valuable. And I remember going back in the early days of the Jobs Act, and you hinted at it, one form of the crowdfunding has nothing to do with raising capital. It effectively is producing a product and being able to pre-fund that. So an organization like Kickstarter, which many people will broadly know from afar as an example of that type of crowdfunding. So that was extraordinary in terms of the opportunity it gave, especially an entrepreneur that didn't have access to capital or was very, very limited. Now, you gave examples earlier of family and friends, but sometimes wonderful entrepreneurial people, their circle of family and friends are going to have very little to give them as well. And potentially crowdfunding becomes a way where they don't need to engage an investment bank and spend even more tremendous amounts of money. Looking back now, it's been about 8 years. Would you say that you've been a little disappointed in terms of the number of companies that have leveraged and used it because there still is unawareness or unclarity, or it's progressed over 8 years about what you expected?
Well, Angelo, I'm not sure what I expected. I'm not sure that I ever expected to get an act passed in Congress. By the way, there's been a second one. It was the FAST Act. We got an even bigger package, even closer to getting passed until President Trump shut down the government over the wall and a piece of legislation, which was called the Jobs and Investor Protection Act. It's a big omnibus package, and it passed the House 406-4. And it included something that was very near and dear to my heart, which was a new form of stock exchange called the venture exchange. And we'd worked on that with Congressman Emmer in Minnesota. It was called the Main Street Growth Act and wrapped into this new bill. And what happens is when legislation goes from one Congress to the next, after January 1, it's mooted. It goes back. So if it hasn't been passed by the Senate, and tragically, that bill was endorsed by the White House. It was supposed to have gotten tacked onto the Senate Appropriations Bill, but in 2018, they never got that appropriations bill done. So, we just have to keep at it. I mean, I got to tell you, nothing good comes easy. You have to be. Fortunately, I'm one of the most persistent, human beings on the face of the planet, and this is Weild & Co. What we learned in the process of doing our work is there'd been a complete collapse in middle market investment banks. We've lost hundreds of them. And so we decided to go in the cloud in a high payout model to start emulating what big investment banks do in the middle market, with scale. And so we're up to 90 professionals in 17 states and the District of Columbia. So on the one hand, we're building a business that we think can become essential infrastructure for the US economy. On the other hand, we're just going to continue to be of service and see if we can't get Congress and the president to come up with innovations. But the big thing that's happened is that we've changed the conversation, right? There's a lot of awareness and focus on capital formation that didn't exist at the SEC with the chairman and with other commissioners. There's awareness that didn't exist in the House of Representatives. There's awareness that didn't exist in the U.S. Senate before. And so I'm cautiously optimistic that while the wheels of progress turn slowly, that we're going to continue to move in the right direction. And then if we give it another 8 years, we're going to look back on it and be very pleased with the toolkits that we've given our entrepreneurs to attract funding and to drive to, I think, as importantly, earlier liquidity events.
Excellent points. And I'm going to start with a comment that I'll try to turn into a question. And I hope it's something that I'm wrong in that, like you just said, being more optimistic looking forward. And it is going to involve a little bit of politics because it's hard not to in the subject that we're talking about. My audience knows I skew towards being a libertarian. I'm always concerned, being a libertarian, I can't help it, about too much regulation, concern over taxes, government involvement. And whenever you're relying on the government to kind of get things done, I'm always concerned and very, very skeptical. We have a very touchy political situation here in the US now. We're a couple of days away from the election. And I think no matter who wins, I don't know if we're in for anything great either way. I hate to be negative. And I know that you're going to say, well, Angelo, if you have no regulation, then you're going to have people taking advantage of people. And that's why starting in 1933 and other times, you need to have regulation. But when is enough enough? If you make it difficult and burdensome for people to start something, when does government know when to step back and when to get involved?
Yeah, I had the head of one of the House committees wanted me to testify that there was too much regulation, and I wouldn't come out with that soundbite, so they didn't use me for this particular hearing. But what I said was, it's not a question of too much or too little. It's a question of intelligent regulation, right? Regulation is what you use to set checks and balances, to put incentives and disincentives out there. And if you get them wrong, or you create too much cost in the process, it's not right size. There tends to be a lot of one size fits all regulation, Angelo. And this is the thing. If you're Apple, with a $1 trillion market value, if you blow up, you're gonna decimate all sorts of pension funds and the like. If you're a company with you could take 5,000, which is the number of publicly listed companies in the country, $50 million IPOs, and you could write a match to them, and it's not going to do the damage to the U.S. economy that blowing up Apple would, right? I mean, think about that and look at the sheer number. So you can afford to take a lot more failure on smaller companies. And so you should have a market structure that allows capital to flow much more freely to get them started, because they are your future unicorns. They are your future apples. And that's the part of the economy that we just really need to kind of figure out how to accelerate. So one size fits all regulation has been really a problem. I would say back in the days of Arthur Levitt, when he was SEC chair, he was the one that drove us down this path of electronic, lower collapsing trading spreads and commissions markets. And it was in response to people saying that we were charging too much. There was actually an academic paper written by Professors Christie and Schultz that had alleged price fixing with NASDAQ market makers. I don't believe that was the case, but that was sort of the rallying cry. And they collapsed the telephone quoted spread markets that worked incredibly well for supporting micro-cap companies, public companies, and then went down this path, which is a one-size-fits-all market. So I would argue they were charging too much money to trade large caps. And so we took a one-size-fits-all market that was great for small cap IPOs and created the greatest new industry birthing mechanism the world had ever seen, and we obliterated it in the name of becoming much more efficient. And we then replaced it with a one-size-fits-all stock market so that we could trade ourselves silly in large cap stocks. And so, what I would say to people is that what we really need is we need two completely separate market structures, because asymmetrical order book securities, which are big buyer, no seller, that's what happens with microcap stocks, need to be structured and treated differently than innately liquid symmetrical order book stocks where you've got 10,000, 20,000, 100,000 people looking at trading Intel or Microsoft or ExxonMobil at any particular point in time. And so there's a lot of nuance in it. And as I like to say, it's not too much regulation or too little regulation. It's more intelligent regulation and a lot less dumb legislation and regulation.
Kind of three questions built into one. Can we bring the small IPO back? And if so, how? And why would that be important?
Well, start with why it's important. You're going to invest in a lot more earlier stage companies if you think you got a better shot at getting a public market liquidity event. And to quote Ray Rothrock at Venrock years ago, he said, it takes an IPO market to keep the M&A market honest. Okay? And if you think about it from the standpoint that capital is on a continuum, it's a supply chain, and a lot of it comes from larger cap liquidity events. If you can't get those companies liquid, you can't refresh the capital. Who's going to invest in early stage companies more than somebody who invests in early stage companies to begin with? And if all of a sudden they make a lot of money and they have a liquidity event, they're going to be right back at it investing in the next one. And so there's capital replenishment. So if you can bring back smaller IPOs by bringing the threshold at which you can go public effectively down to a much lower level, what you're going to end up doing is dramatically increasing access to capital for entrepreneurs. And I think that's the objective. For us to do that, we need a new stock market. And a lot of people will ask, for instance, about the importance of SPACs, and because we're in a marketplace right now where we've seen 120 SPACs filed, and we're starting to see the number of SPACs eclipse the number of regular way IPOs. Why is that happening? Well, that's kind of a sign of a market that's not functioning properly, right? Because what's happened is that the distribution and the quality of distribution from Wall Street has declined dramatically, and they're no longer distributing shares to the right long-term investors because they no longer have an economic model to cover long-term investors. If you think about it, your turnover rate as an institution, if you're a long-term investor, is very slow. So the amount of commissions you can generate is very low. So there's no economic model for Wall Street to effectively cover those low commission paying accounts who are some of the best owners. This is one of the reasons why you're also seeing Silicon Valley move in the direction of direct listings and trying to avoid Wall Street altogether, because what's happening is there's probably 60 institutional investors that are generating 90% of the commissions to Wall Street. And the turnover rates in those accounts is either exceedingly high, meaning they flip stocks or to generate commissions, or they're so large that they really can't own smaller capitalization companies, right? They've got $1 trillion in assets under management if you're BlackRock, so they're liquidity constrained. So there's this complete mismatch the big Wall Street firms have with the issuers, and it's all because the economic model no longer supports broad-based distribution. Look what's happened to retail in this country. Retail is no longer retail brokerage. It's accumulate assets and earn a percentage of those assets for allocating stock to, funds or managed accounts. And so the whole stockbroking and distribution business on the retail side as well has been completely obliterated. And so, to answer your question, if you get the economic incentives back into the market, it's going to take a number of years for people to build back the ecosystem to broadly distribute securities and take more companies public. But we don't take them public at earlier stages. Why? Because the entrepreneurs have figured out that there's not a high likelihood of a positive outcome. It's very risky. So take the risk off the table by creating a blind pool, a SPAC, give up 20% of the upside, so it's structured right, but you're willing to take that path to avoid the uncertainty of getting a deal, having a failed deal, right? But that's not a solution. That's a sign of a market that is no longer properly structured to support capital formation, which, by the way, is one of the three things that the SEC is supposed to support in their mission statement. I mean, we're failing at that because of a one-size-fits-all market structure that is really more geared towards enabling passive investments and hyper trading, and no longer properly raises capital.
Yes, that was actually kind of one of the questions that came in. Will SPACs continue to act as an alternative IPO mechanism as things currently are structured, perhaps? And by the way, for those that may not know the acronym, Special Purpose Acquisition Vehicle, look it up. They've certainly become very active in the community for investors over the last couple of years. What other, and I'm asking a question from one of the attendees, what other regulatory and or legislative changes would continue to create innovation and entrepreneurship?
Well, there are a lot of things that we can do and address. One is tax incentives to get money. I'd love to see a tax credit for rich people to invest in entrepreneurial startups and in depressed areas of the country, targeted opportunity zones. I think that the opportunity zone legislation hasn't been particularly effective because the holding periods are too long. But there's something really magical about bringing the American dream into poorer areas. There's lots of people that have lots of innovative ideas, and they just can't get things started because their friends and family don't have any money, and that's how startups are frequently funded. I'd love to see us go back to a market structure that essentially, this is what the Main Street Growth Act with Congressman Emmer was supposed to do. If we went back and we systematically looked at the regulatory changes that occurred, and some of them driven by Congress, some of them driven by the SEC, that led us away from the greatest IPO stock market trading and support model that ever existed to the current one, which say just allow stock exchanges for companies under $1 billion or under $2 billion to design a market where they're not encumbered by having to conform with regulation ATS, the order handling rules, regulation NMS, and start from scratch and design it like we did in the old days, where we understood that the profitability of the broker dealers was critical because they have to provide the support with research, banking, sales, and trading, where we give a seat at the table to smaller institutional asset managers that are committed to the microcap space, and design a market that that works to provide real market making support, where a big seller of 500,000 shares of stock on a stock that trades 10,000 shares a day can talk to a trading desk, and the trading desk can hold the stock there, and they can break that stock up into smaller increments, 500, 1,000 share blocks, and have brokers smile and dial and replace that 500,000 shares, so that you don't have this problem, which you have today, of that 500,000 share block, if it's seen by the market, depressing the share price, and creating a situation where any gains that you may have already booked have been completely lost because the stock, because of adverse trading interests that are coming after you electronically. I mean, there's entire industries now set up around latency arbitrage, sniffing what you're doing, getting in front of it. I mean, we all probably familiar with the Flash Boys book and Brad Katsuyama, who came to the conclusion that if you slowed down, there's 50 plus trading venues now. If you slowed down the rate at which you hit bids, that if you go to 50 different trading venues and hit them simultaneously and get a better size execution without tipping to the market, that you were in the market selling a block of stock, that you could come up with a better result. And but I mean, what Brad tried to do there is to engineer a solution which was really causing fundamental institutionally oriented investors, fundamentally oriented institutional investors, causing them to kind of leave the market for these securities because of the slippage that would occur. It's a trading term in share price when they were trying to get into a stock. The stock would move up in front of them, where the stock would move down when they were trying to exit a stock, which was killing their returns and chasing institutional capital out of smaller capitalization investment.
Yeah, very interesting points. We actually had Brad speak at one of my physical events back in the day, probably 2015. Yes, pretty amazing. Are we in danger of potentially shooting ourselves in the foot by potentially propping up historically important businesses, such as industrial companies, think automotive and energy, which now comprise less than 3% of the S&P, instead of continuing to shift towards an economy of higher entrepreneurship, technology, deep tech, et cetera?
Well, I think like everything, it depends. And, I am very concerned about, supply chains. I think we learned that that all of our PPE, for instance, during COVID was being produced outside of the United States, and we ended up with a shortage. And I think we still have a manufacturing shortage. There are things that we need to be self-sufficient around. We need to have manufacturing capacity. We were a great manufacturing nation in the Second World War, and we took a lot of these plants and we ended up being able to produce material for the Defense Department, and as a consequence, we after having been set on our heels because of the bombing in Pearl Harbor, we were able to very quickly kind of marshal those manufacturing resources and ultimately defeat Adolf Hitler. So I think that there are two pieces to that. It's strategically, what do we need to do to defend against our enemies, and that requires some commitment to manufacturing, I believe, and all sorts of manufacturing and technology. And then the rest of it, I would agree, is there are certain things that we don't need to prop up. But look, I mean, we've taken a backseat on the antitrust front, and we haven't been very aggressive there. And there's some massive industries. I remember when we broke up, AT&T and unleashed a wave of sort of competition. I mean, the banking system in this country, I think somebody said, I don't know who it was, might have been Alan Greenspan, but probably get this wrong, but it was if you're too big to fail, you're too big, right?
Yes.
And we've bought the line that we can't break up the banks. Well, nonsense. You can break up banks, large banks. We need them to be of a size at which we can allow competition to sort of work and things to fail and not have to step in with the people's money. Or we've got to get our deficits under control. I mean, look how much money we pumped into the system, how much liquidity now as a result of COVID. And what we're doing on some level is we're just mortgaging the future of our kids. And so I think it takes a little bit of coming together, Democrats and Republicans, to sort of, try and do a better job of figuring out what kind of a legacy we're going to leave for the next generation.
Well, that does beg my next question, which is one of those uncomfortable ones. It's not an easy one. We have a deficit that's getting bigger and bigger. We're nowhere near the end of COVID-19. This is very late October of 2020. And here in the greater New York area, imagine restaurants and small businesses like that are no longer going to have the availability of limited outdoor seating, which probably makes them bordering on profitable. This is going to get worse, I guess, economically, right or wrong, before it gets better. You're talking about job creation, entrepreneurs, but in certain industries, restaurants and pizzerias, which is a restaurant, stuff like that, wow, they're in a really, really bad shape. And that's millions and millions of Americans. I don't see an easy way out of this.
Well, it's going to take, excuse me, it's going to take a while. I do think that, we haven't managed COVID particularly well. You only needed to look at Asia back in March and see everybody running, and this is March of last year, to see everybody walking around Asia with masks on. And, I think it was pretty obvious that either all of Asia is not very smart, or all of Asia knew something that we didn't know. And I think that the latter is more likely. I actually happened to go speak for the OECD about a month ago in South Korea at the World Knowledge Forum. And I got off the plane, and I had an exemption to go speak at the conference, because otherwise everybody that comes in off of a plane is quarantined for 14 days. But that exemption required that I get a test, and the test was closed, right, for the day, because I came in late to the airport. So they couldn't do it at the airport. So they bussed me to a hotel, and on the bus, I was met by two people in hazmat suits. They took some information. They checked me into the hotel. They sent me to the room, and then two other people in hazmat suits showed up at my room and did a nasal and a throat swab. The next morning, I got the negative results of my COVID test, and they allowed me to go to the conference. They aren't messing around. Every time I walked in and out of a building down there, they took a temperature, they gave me hand sanitizer as I walked into the building. Everybody's required to wear a mask. And I lost track. I haven't looked at it a couple of weeks, but they were less than 500 deaths in the entire country of South Korea, and we're over 220,000. So, we can be the masters of our own destiny if we just stop acting like anarchist children, and start respecting our neighbors, and getting out there and doing what it takes. Because right now, people are dying as a result. I mean, we got to worry about what's going to happen now and for Thanksgiving and the Christmas holidays or Hanukkah. And if you do get together, and you got younger people who are much more resistant to this disease. By the way, I've worked on a couple of COVID drugs, so I'm dealing with a lot of the scientists on the science. And the kids coming back from college are pretty impervious to it. I mean, there's been very few deaths if you look at the CDC numbers for people in the 15 to 24 year age range. But if they're introduced to older people or people with pre-existing conditions and so on, you could have a real problem over the holidays. So, we need to have a little bit of an epiphany and stop politicizing it. And I don't want to get into politics, but literally we can do so much better. And I think what we've done in the process, by taking a lot of the money in New York City, people with money moved out of the city, and they're the ones that spend in a lot of these restaurants. We've exacerbated the problems of some of the restaurant owners and the like. We've really mismanaged this problem, and it's kind of tragic, because a lot of people are going to suffer, and the deficit is going to be dramatically greater than it needed to be.
You mentioned some to make tax incentives, and I think back to a guest I had on last week, that spoke about, I believe it's known, and it's relatively not well known even by tax accountants, QSBS, where there's some tremendous benefits. US company, US citizen, there are certain holding periods, but whether to have better if it's profitable on your gains in terms of some tax incentives, but very, very beneficial if the company just totally craps out. You need to be with it a certain number of years. There's a fair number of guidelines. I almost wonder if we have some of the right things on the books right now. They're just not either updated since they were originated decades ago, so the amounts need to increase, or they need to be better well known.
Well, I think there's a little bit of both. You create toolkits for people. They figure out how to use them. But I think some of our tax incentives do work, but I think a lot of the tax incentives that have been created sometimes require too long a holding period or don't give an immediate benefit. And so that's one of the reasons why I said tax credits as opposed to better tax treatments effectively give people leverage. I mean, if I gave you $1 worth of a tax credit for every $1 worth of investment that you made, you get $2 to put to work. I mean, I don't know that it needs to be that large a benefit, but it gets people to sit up and pay attention.
Absolutely.
And if it was for earlier stage companies and they kept the jobs in targeted economic development zones, you would end up with people like Bruce Lincoln, who I know from Silicon Harlem, setting up incubators in places. And showcasing their investments and qualifying their investments. I think you could unleash a wave of entrepreneurship and innovation that would make your head spin. Look, the only way that I can see that we are going to, fix the deficit problem, because we have it now and we're going to have to live with it. We've got to pay it down, is by growing our way out of it. And 3% growth of GDP. I don't buy the economists' argument that that's the best we can do as a country. I mean, China's been out there kicking for years, 8 and 9% growth, and India has been higher. I mean, why the heck can't the United States do 5-6% growth a year without, and I think that we can, but we need capital to go into earlier stage companies at a level that we haven't seen before. And then I also think that on the immigration front, if you go back to the Second World War and the Manhattan Project, I mean, we beat ultimately the Nazis to nuclear weapon, basically because we opened up our doors to the best and the brightest, mostly from Western and Eastern Europe, and a lot of European scientists. And so, we are ultimately going to lead because we are a gray matter economy. We are 25% of all STEM graduate students in this country, science, technology, engineering, and math, are from China. And we're sending them back to China. We're teaching them science, technology, engineering, and math, and we're sending them back to China. How crazy is that, right? So, I want us to take the gloves off and compete, and I think we can. This sort of claptrap that we're sunsetting and we're in decline as a nation, I think is grossly oversold. I think we can still be the best and the brightest and the last remaining superpower, but we got to get our act together.
Maybe two final questions from our audience. David, can you opine on the Biden tax proposals? What might the Biden proposals do to address or exacerbate the issues that you're raising now, or they don't address them at all?
Well, I give you two parts. I mean, obviously, I'm not wild about increasing taxes on people with with 400,000 or more in compensation, because as we all know, in the New York metropolitan area in particular, you've got pretty high SALT taxes, state and local taxes, and those are not what I would say wealthy people. I also believe that that one of the things that maybe people don't appreciate, the gentleman who is Joe's head of his transition team is Senator Ted Kaufman. And Ted was Joe's longstanding chief of staff, and when Vice President Biden went to become vice president, Joe took over his seat. Joe is a Wharton grad and very trusted friend and advisor of the vice president. Senator Kaufman, gave a speech on the floor of the U.S. Senate saying that if we could get the $25 million IPO to work, we would get America back into business. He was one of the first people on Capitol Hill that picked up on our written work and advocated for capital formation. He wrote letters to the SEC, jabbing them. And so I think that maybe I have a high degree of optimism that both, either Trump actually was very supportive of that act that I told you. He put out a press release on the White House's blog. But I also think that a Biden administration is going to be very pro entrepreneurship, and I'm hopeful that we'll get there. So either way, I think the most important thing is for America to get back to business. And, we've gone through, every time we go through a presidential election, everything stops in Washington for a period of time until we seat a new Congress. And so I'm hopeful that we get into the new year that we'll be able to get back to business and maybe move the ball forward for the American people.
I hope so. Perhaps the final question, it comes in from one of our participants. We actually, David, caught up a little bit about it offline, but we'll bring it online. What do you see happening with the tokenization of assets space, especially against the backdrop of liquidity crisis around the corner, if not here yet, in parentheses? How is it the same but different than crowdfunding, presumably tokenization aided and abated by blockchain-enabled technology?
So tokenization, there's three layers, right? And they sometimes exist independently. One is the blocker, the general ledger, that just keeps track of transactions very cost effectively. We've had general ledgers, on Wall Street forever. The next one is the smart contract layer, which is sort of interesting, which is that particularly in private markets, you could do things that effectively do all the legal checks and take out the cost or the constipation, if you will, in trading private market securities, because you can comply with the laws very quickly. Here's an online identity of somebody that verifies that they're an accredited or a qualified institutional buyer, and that all that process can be automated. And then there's the token itself, and tokens have existed for a long period of time, right? I mean, when you were downloading software, you got a license, and it was a token, it was a hash, and it just didn't trade. So tokens may or may not trade. And so these are, if you will, component pieces for highly integrated systems. But when you look at sort of clearance and settlement, one of the wonderful things about the block is that it can do it instantaneously. So you could move to T+0 effectively, and it's very cost effective. And so there are some things that it applies to. Just because you tokenize something, though, doesn't mean that it's going to be liquid. And so if something was innately illiquid in the public equity markets because it was a microcap, asymmetrical order book stock, big buyer, no seller, big seller, no buyer, it's not going to be inherently more liquid because you tokenize it. That part of that sort of, when you go to these blockchain conferences, a lot of people just think tokenize everything, you're going to make it liquid. It's incredibly naive. All right, microcap illiquid securities turned into microcap tokens are still going to likely be illiquid, but there are things that you can do much more efficiently. And so we're going to see innovation in security structure through tokens. For example, you could pay dividend distributions at a much higher frequency rate because the frictional cost of doing that is just bits and bytes.
Right.
So, and investors value that. So I could go to a security or a token structure, and I could, in theory, I could pay you your little bit of distribution every hour. I'm not sure how much incremental utility is there, but right now, if you look at closed-end bond funds, for instance, or REITs that are traded on the New York Stock Exchange or NASDAQ, you usually don't see them any more frequent than monthly pay. But it's interesting because the monthly pay structures trade relative to net asset value at about a 4% premium to the quarterly pay structure. So there's obviously utility in the minds of investors with higher frequency of payment. My guess is that weekly payments structures you'll see, and people will appreciate those. So tokens and tokenization in block, it's a little bit reminiscent to me of moving from physical delivery of stock certificates to electronic delivery, DTCC, and now to tokenization. I think it's going to, and the block, I think it's going to happen. I think people, out of MIT, there's a great saying that people tend to overestimate the impact of technology over the short run and underestimate the impact of technology over the long run. And I'm very confident that most of these systems will end up, most trading will end up being done on the general ledger or block at some point through tokens. We're in the middle of a kind of an early phase of transition, but some of the basic rules that illiquid stocks are still in all likelihood going to make illiquid tokens.
Yeah, very good points and very accurate what that's saying about technology. It's so true. And my audience has heard guests we've had on before. A reminder, the internet was invented, US Army or government in like the early 70s. And it started to take off a little bit in the early 80s, but really until like AOL and all that in the closer to the early to mid 90s it took. And then once it got to that level, it was incredibly exponential. And I think that blockchain, for the reasons you're noting, it's been about 12 years now. We're not quite there yet, but we're getting a little closer all the time. And eventually it's going to hit and really be very exponential. David, I do want to be respectful of your time. You're doing amazing work. You hinted a little bit at it earlier. If you could tell our audience a little bit about your company, Weild & Company, and how really it's changing, potentially it wants to, the economic infrastructure of many of the things we're talking about now. How could people learn more?
Well, they can reach out to me. It's easy to reach. Is david.weild@weildco.com. And I'm also on LinkedIn. Hook up with me on LinkedIn. We want to create something that's never existed before, which is, I ran a top 10 investment bank years ago. We want to virtualize it and stick it in the cloud. And we want to bring all those people back into the workforce whose licenses have expired, that worked at Goldman Sachs, that went on the mommy track and want back in. We want to take guys who are have incredible Rolodexes and because of the kind of the ageism and the rationalization of Wall Street, may find themselves in a down cycle, out of a job, but they still want to work until they're 80. And we're bringing all sorts of those folks into the economy and putting them to work in the middle market, and we're getting deals done, and we're seeing people start to collaborate and work together. I mean, I've got so many amazing people that we're seeing. I mean, out of Citibank, I've got guys that were at Morgan Stanley, Goldman Sachs, and smaller firms, some of the four horsemen, for those of you that remember. I know guys that I was working with just before I got on the phone, who was an old Robertson Stevens banker, and working on a secondary sale for a CEO who left a company in an online mattress company, and that's been growing like a weed. So we see fascinating kinds of deal flow. As you can imagine, we're 90 professionals. We have 70 active deals now, Angelo, and we want to take this to 1,000 people over the next 5 years. And if those numbers, those ratios hold up, we'll be seeing 700 deals. And but I think that there's you've seen this kind of moving up market from the collapse of the middle market, and there's no shortage of deals. There's shortage of organized execution talent, and investment banks, you need industry experts, product experts, and you need, sales forces. We just established and are starting to build a family office sales practice, and we've had some people join us, so I think the world is our oyster here. I mean, we have an amazingly large opportunity. If you study network effects, we are what people we think call a Reed's law, which is that the numbers of bankers, our revenue should increase at a faster rate than the numbers of bankers as they start to organize into clusters of expertise and are able to pick and choose and do and be better at delivering closes on deals. And so we're in the early throes of starting to see that thesis take shape. And so and at some point, investment banks want to layer on money management. I'd love to be able to put in, a bridge fund, or something like that, because we see a lot of companies that could use an injection of capital before a bigger deal gets done. So, we're doing the heavy lifting and trying to make a contribution. And this is, we used to call it this. We used to literally call this the God's work of investment banking. I mean, this was the stuff that employed people, that forwarded the nation, and this nation has gotten away from it because of changes to market structure. And I don't fault people for not taking the hard path, but this path is absolutely essential to where our kids are going to find themselves over the next 30 years. And so I think it's a fight worth fighting. It's a labor of love. It's not just a business. It's a movement. And for those of you that are interested in joining the movement or helping, I'd love to talk to you, because we got a lot of work to do.
That's fantastic, David. It sounds like really a wonderful initiative, and certainly hope that people have a chance to reach out. Everyone, I am Angelo Robles. I'm the host of the Angelo Robles Podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth and their single family offices. We provide original proprietary content, host literally hundreds of digital programs now during COVID over the course of the year, practically daily, and are very active with our master classes and really anything and everything from the family office perspective. Check us out. Our website is familyofficeassociation.com. My email is angelo@familyofficeassociation.com, and subscribe to our YouTube channel, which is Family Office. It's very easy. We're also very active broadly on all social media platforms. David, you've been amazing. I look forward to the next time. Thank you for joining us today.
Thank you, Angelo. Appreciate it.
Thank you.